Here at VINwiki, we talk a lot about exotic car financing, and anytime you bring up that concept, people immediately rush to their keyboards to say, well, if you can't write a check for it 5 times over, or you're never going to be able to afford the maintenance, like you should never finance a car. But I'll be honest, if you walk around Cars and Coffee, no matter where it's at in the United States, about 75% of the cars that are there are going to have some kind of loan or lien attached to them. And in a world like we live in today, where everything, values are on the rise, let's say 3 years ago you bought a 2015 Lamborghini Huracan, you paid $180,000 like you could have, and now it's worth $240,000. Well, if you had that title at home in your desk drawer, you've made about 30%. That's awesome. But if you put 10% down on that same level of appreciation, your profit on the investment would be 300%. Now, I'm not advising cars as an investment. They're a way that I've earned a living, but not necessarily due to the appreciation, due to arbitrages and other things that we've talked about. But regardless, there are plenty of people that want to finance exotic cars. And about 4 years ago, I kind of made a guide to exotic car financing, and certainly a lot's happened in the industry since then. And so I wanted to talk a little bit more about it today. And in my opinion, the best way to understand how exotic car financing works, particularly if you're trying to approach that for the first time, or you're trying to trade a car in or something like that, is to look at what a perfect scenario would be from a bank's perspective and then figure out how you measure up. And in many cases, as we look at all the criteria that a bank is going to consider and whether or not they approve your loan and fund it to a dealership, the best thing to do is think, well, if I don't quite measure up in one criteria, there's a good chance that I can sort of overcome it with outperforming another one. Now, the biggest thing that's changed over the last few years as you look at the idea of financing an exotic car is the reality of loan to value. In most cases, a bank wants you to reduce their position with respect to the car's value by about 20%, a down payment, a cap cost reduction, whatever the case may be, to improve their position of collateralization by about 20%. They want a loan 80% loan to value. Now today, where there's market adjustments on new cars, there's massive appreciation or overvaluing in pre-owned cars across every possible manufacturer, that's getting harder and harder. So a lot of banks are agreeing to advance further. They're agreeing to loan more money per value on a car. In some cases, on a new car, you might see 100%, 110%, 120% or more that a bank, especially a captive lender like Porsche Financial Services, BMW Financial Services, is willing to advance on a car. Now, you can imagine that that could become a very catastrophic position in the event that the cars, which they inevitably do, depreciate. Now, in the aggregate, cars depreciate about 1% a month. And as we look at the spectrum of options of exotic car financing, most of the payments are going to become 1 to 2% per month. So you could see how it's easy for the depreciation to sort of outpace your pay down of the loan. And that is a liability. And so when a bank asks for an improved loan to value position, that is the risk they are trying to avoid. They're trying to avoid you getting into a negative equity position. Now, our goal in owning anything that has a loan attached to it, whether it's a house or anything else, is an equity position. That becomes a positive part of our net worth calculation. But in the event that you have a loan that is greater than what you could realistically sell your car for the next day, that becomes negative equity, or you might hear it called being upside down. Now, sometimes you'll hear a finance manager or a salesperson talk about burying negative equity in the next loan. So for instance, if you owed $100,000 on a car that's worth $80,000, you might agree that, let's say the next deal is a $150,000 car, that you're buying a $150,000 car and you're trading in an $80,000 car. That's a $70,000 delta. But you don't want to show the bank that negative equity spread. So what you do is you adjust both numbers up. You buy the $150,000 car for $170,000, you get $100,000 for your trade. The dealership still collects the same difference. They're happy. The bank feels better about it. You still put a little bit of money down, but not necessarily all the negative equity plus some down payment on the new car. I know that seems complicated, but that's how it happens every single day. So we are seeing banks advance more in terms of loan to value, but a lot of the rest of the stuff is still the same. So you're still going to be looking at a similar debt to income calculation. Now, if you go out and you apply for a mortgage, in most cases, debt to income is calculated as all of your monthly bills need to be 40 or so percent of whatever your gross monthly income is. So if you have a mortgage, some utilities, a car payment, a cell phone payment, anything that's going to show up on your credit report, the sum of those payments needs to be about 40-45% of whatever it is you make on a monthly basis. In the car industry, we calculate that a little bit differently. In general, a bank only wants the sum of all of your automotive loans to be 75-80% of your total annual income that you can prove. Now, a lot of people who are self-employed or whatever struggle to prove their income, and so your verifiable income should be considerably more than the amount that you're trying to borrow. If you make $100,000 a year and you want to buy a $150,000 car, you should expect to have to put down more than $50,000. Even if the loan to value wouldn't require you to do so, they still want to make sure that you can afford it, and that, in most cases, is the metric they use. Of course, there's times where they get advanced beyond that, and that's because, in most cases, of really, really good credit. Now, credit gets evaluated in a couple of different ways. One is obviously your score. We all know that if you have a Social Security number and residence in the United States, you have a credit score. It might be 300, it might be 850, but it's something in that range, and the higher it is, the more qualified you are to be loaned money. Now, if you have anything over a 720 or a 740, almost all banks are going to consider that top tier credit. Having an 800 doesn't really put you in that much of a better position than a 740 because honestly, the difference is usually just the percentage utilization on credit cards and things like that. That's kind of a snapshot, and that's going to fluctuate by maybe 20 or 50 points throughout the course of a month. And so as long as it's generally high and there's nothing derogatory. Now, if you hear a finance manager say that there are no derogs, there's nothing derogatory in the credit report, that means there were no late payments, there were no repossessions, there's no foreclosures, there's no bankruptcies and things like that. And those will show up for at least 7 years, in most cases, even more. And if you've never had a loan go bad, you've never been more than 30 days late or things like that, then in most cases, your credit score is going to be very high. The other way credit is evaluated in a car loan is on your prior comparable credit. So have you had another car loan that you've performed very well in paying, and how does that stack up against what you're asking for again? In most cases, a bank doesn't want to go beyond your previous high car credit by more than about 50%. Some might go 100% beyond. If you had a $50,000 loan that you paid perfectly for 2 years, they might give you a $100,000 loan, but they usually don't want it to be a massive jump. If you financed a $20,000 car 5 years ago and you paid it off after 6 months and then you come up wanting a $200,000 car, that's going to be a strike against you because they want to make sure that you're not getting too far ahead of yourself and you're not going to be overextended. So after we deal with the acceptability of the loan to value, the qualification of your income, and hopefully you haven't photoshopped tax returns, but I'll be honest, those get through every single day in finance offices. You're not in most cases giving the finance manager permission to re-pull your tax returns from the IRS the way you would in asking for a mortgage, but I would never advise that anybody lie about such things. You've pulled your credit to get the score, you've seen what your comps are, then you're going to start looking at exactly how the loan is going to be configured. Now, there's a lot of different loan products and there's a lot of different banks out there, and you're going to see traditional car loans, extended term car loans, closed-ended leases, and open-ended leases. And in the exotic car world, you see a lot more of those last three. Most people, they walk into a Ford dealership to buy a brand new F-150, they're just going to get a normal car loan. That'll be 48, 60, 72 months, maybe 84 on a brand new car, even 96 in some cases from captive lenders. And they're going to go out there and they're going to get an interest rate in most cases for a well-qualified buyer that's kind of satisfying all these criteria that we're talking about in the 3, 4, 5% zone. In some cases, you'll see advertisements for 0% financing. That's not real. In fact, what's happening there is that the interest is being prepaid by the dealer out of the profit that exists in the car. I know it seems too good to be true because it is. In all of those cases where you're getting a payment book that has zero interest calculated, that is because you've given up some other discount that you could have gotten if you had financed the car traditionally or if you had just paid cash for the car. They're putting a rebate or they're putting some incentive or just some profit that they didn't have to give away towards prepaying the interest. That is the opposite of a way that finance reserve is calculated in what's called indirect lending. So if you walk into a finance office and you say, I want to finance a car, that is what's called indirect lending. If you go to your credit union and you get pre-approved and you take in some kind of paperwork that explains to the dealership how they get your money from the credit union, that is direct lending. You've applied to the bank. If you apply to the dealership and they apply to the bank, That's indirect. Now, there are some big advantages in some of your first exotic car loans to using indirect lending because you don't say something stupid that the bank doesn't want to hear. Of course, the dealership does this every day. They know what the bank is looking for. They know everything that I'm talking about right here, and they can package your application in the most compelling and interesting way that the bank might look for. If you apply directly, you might say, well, this is different, this is that, whatever, that, where the dealership just won't ever say that because they know it could be a red flag. So you're going to get approved a little bit easier in an indirect way, but you might not be getting the interest rate that you deserve. What happens in that equation is that the bank responds to the dealership with what is called a buy rate. And the dealership can mark that up. Usually it's going to be capped at either 1, 1.5, or 2%, sometimes even beyond that. In the Wild Wild West 80s, they might have marked it up 10%. Whatever they could convince you to sign, they got to make money in the rate spread between the sell rate and the buy rate. Again, in most cases, it's not going to be exorbitant, but you can usually negotiate the rate down. And while they may say they're talking to the bank, all they're doing is giving up some of the rate spread that they've been able to create in your perception of what you've qualified for. So that is a profit center for the dealership. They will earn more revenue from the bank and essentially a kickback for having helped them to create this new loan. And the opposite is happening if you get 0%. They're having to pay finance reserve to the bank to buy down the interest rate from whatever it is, in the same way that some mortgage documents might have you buying down your interest rate on your home loan. Now, in particular, when it comes to exotic cars, it's very important to understand that not all banks are created equal. In many cases, you're taking someone a more obscure car that's a little bit older, that's a little bit harder to finance, because if you try to finance a 5, 8, 10-year-old car through a traditional bank or credit union, in most cases, they're not going to know what to do. They're used to financing certified pre-owned cars or brand new cars, cars that are very new, that are reasonably safe from a long-term depreciation perspective, and don't have the chance of a $30,000 double clutch transmission failing. And so when you're talking to an exotic car bank like Premier Financial Services, one of our frequent advertisers here on the VINwiki channel, they understand the cars and they understand how to package a deal in order to make both of you safe. They want to make sure that you don't get into a negative equity situation. And they also understand that they're sort of advocating on your behalf in many cases to get you the best deal possible with the dealer. So if you call Premier Financial Services and you get pre-qualified for what they call their simple lease, which is effectively an open-ended lease where it's structured as a lease, it allows you in many cases to pay with pre-tax dollars, it allows you to minimize your out-of-pocket up front, it gives you the flexibility to move in and out. But the paperwork and the structure is like a lease. Just at the end of it, usually a 60-month term, you're either going to refinance it, trade it in, or you may just sell the car at that point. It's not like you just turn the keys back in and drop it off at your local dealership. There are closed-ended leases that you will see on brand new cars, BMWs, Porsches, and things like that, that we're always kind of trying to get to that 1% per month to become a really, really good deal with nothing major out of pocket other than maybe some taxes and things like that. But the closed-ended leases are made a little bit more specifically for the exotic car industry. I do love Premier. There's other companies that do similar things. You'll also hear about some extended term financing companies that do a 100-month term or a 144-month term. Again, in those cases, they're going to require more money out of pocket up front because they know that if they're letting you finance it for 12 years, you're not making a lot of payment to principal in those first few years, and there is a huge chance, if the car depreciates, that you could get into a negative equity situation. So in general, that is how exotic car financing works. My personal approach, and honestly my personal advice, is always look for cars that are more depreciated. That way they're not going to depreciate as much while you own them. That's why I try to look like I won the lottery 10 years ago. Obviously negotiate all aspects of it as shrewdly as you possibly can, and that comes from going in knowing these types of things. If you go in just asking questions, they may be able to take more advantage of you. If you educate yourself, if you pre-qualify with a bank like Premier or any other bank that you might want to use, it can be a wonderful experience and you can own the car of your dreams a whole lot earlier than you could if you had to write a check for the full amount. So thank you so much for watching. If you have any additional questions about how exotic car financing works, please ask me in the comments and I'll be more than happy to answer. In addition to thanking Premier Financial Services for their support of VINwiki over the last 5 years now, I'd also like to thank this month's sponsor, Avalon King. Avalon King's Armor Shield 9 ceramic coating is one of the best DIY products in the industry. It's something an idiot like me can put onto their cars, and I have it on all of mine. It makes them easier to clean, it protects the finish, and it makes it shine like nothing I thought I'd ever be able to achieve. So please check them out at the link in the description below to get their best deal possible, and thank them for their support of VINwiki. Have a great day.